Good afternoon and welcome to another VSA Capital Tech and Transitional Energy podcast with myself, Phil Smith, analyst, and this week as guest David Scriven from our institutional sales team as Andrew is away on business. David, welcome. How are you doing?
Not too bad, and thank you very much. I've got a little bit of a husky voice, so do forgive me if I lose track because of that, or I have a little bit of a cough. But anyways, lots of exciting things going on, and of course, the headline overnight, of course, would be Nvidia, which reported Q4 sales of 39.3 billion, which matched expectations. The company got 11 billion in revenue from Blackwell, which Nvidia described as the fastest product ramp in its history. Demand for Blackwell is amazing, CEO Jensen Huang said in a statement. The data center unit, the biggest source of revenue, generated sales of 35.6 billion and beat the street at 34.1. This data center revenue alone is more than Intel and Advanced Micro Devices generate in total. Now, Q1 sales expectations are for 43 billion versus the street at 42.8, with some analysts out there at 48 billion. And the company guided to a gross margin of 71% and below street expectations. The CFO said that the expense of getting a product to market has weighed on margins, and savings will come with supply chain refinements. Gross margins, thus, will return to the mid-70s by year-end. The mixed outlook, plus lingering concerns on AI spend. Bear in mind, a day or so ago, Microsoft was off on an analyst report that the company had cancelled some US data center leases, and US tariffs perhaps explain why Nvidia was down in after hours. The semiconductor index, the SOX, has not recovered from breaking its key moving day averages and is at a midpoint of a 6-month channel of 4,500 to 5,500. We are perhaps in a digestion phase where macro factors such as tariff concerns, sector factors such as hyperscalers like Microsoft CapEx spend, deep seek implications, and stretch valuations are all playing their part on share price performance. But I'd watch out for Broadcom on the 6th of March in their Q1, with analysts touting that the Q1 is going to be good and Q2 guidance will be on the upside. The artificial intelligence ETF is currently at 1814 and still shy of the all-time high of 1938. Now, one of its composites is Crowdstrike, which has released a 2025 global threat report, which states that China's cyber espionage is growing more aggressively. In other words, last year saw a 150% surge in espionage attacks, with critical industries seeing a 300% spike in targeted attacks, and AI-driven phishing and impersonation tactics fueled a 442% increase in voice phishing in the first half of 2024. Now, they report on the 3rd of March as well, so look out for that. The cybersecurity, unsurprisingly, the ETF has a similar pattern to the AI one. In the battery value chain ETF space, it's at the low end of a channel, but has not broken the 200-day moving average line. Tesla's EV sales plunged 45% last month across Europe, with 9,945 cars sold versus a year ago at 18,161. EV sales soared 37% for the overall industry, with car makers posting gains in Germany and the UK. Now, Tesla's share price is down by a similar amount to that sales plunge from its December high of 2024. Countering this, within the ETF, Panasonic reported third quarter results and a management reform plan that was well received by analysts, and the stock is at a year and a 5-year high. In the clean energy ETF, it looks range bound at 737 and is well off last year's high of 840. Now, First Solar shares have been in a downtrend for a while, but a mixed Q4 revenue beat but EPS miss saw the share price rally yesterday about 10%. It'll be interesting to see if this continues and breaks the trend. The S&P software index is down year to date and broken all three moving averages. Intuit reported a Q2 that topped estimates, and Bloomberg reports that Morgan Stanley sees positive revisions near term in the earnings. Palantir is off on the concerns that the Trump administration could cut military spending. So we'll have to keep an eye out on that. And I'll hand it back to you, sir.
David, thank you very much for that update on the broader markets. I'll talk a little bit now about UK results that have come in the last week. And the first one is of course Rolls-Royce, who reported today. Rolls-Royce, also in aerospace, defence, and power generation markets. The new CEO came in just over a couple of years ago now. The business has been in turnaround phase, but also the business has been, benefiting from an uptick post-COVID of civil aerospace, but it's been restructured as well. Anyway, looking to these results, it was a super set of numbers from Rolls-Royce. The sales were increased from 15.4 billion up to 17.8 billion. And this dropped through to the margins in the business, and the operating margins underlying grew from 10.3% to 13.8%. And I think what was really interesting in this, David, was that the margin rises were across the core business sectors of Rolls-Royce. So with civil aerospace, margins were up to 16.6%, 11.6%. They were seeing a higher share of the wide-body jet market. Remember, Rolls-Royce is a big provider of engines into the aerospace markets, particularly civil aerospace, but also defence. The defence business margins were up from 13.8% to 14.2%, and power systems from 10.4% to 13.1%. But it was very interesting to see some of the drivers in this. Now, clearly, passenger volumes have been increasing over the last, post-COVID and over the last couple of years. And what increasing passenger volumes and more flights means is that more maintenance is required on the aerospace engines. And Rolls-Royce is seeing its maintenance revenues grow in civil aerospace as well as sales of new jet engines. In defence, it's particularly strong in the submarine market. It recently announced a £9 billion contract with the UK MOD, but also it's deeply involved in the AUKUS project for submarines. And in power systems, I mean, they're big. Rolls-Royce, big manufacturer of generating gensets for power, as well as increasingly battery storage systems. But a lot of this is being driven. Its demand is being driven by data center, growth in data centers, and so it saw, very strong increase in sales in power systems. So, all in all, for Rolls-Royce, super set of results. And I looked at the share price a few minutes back, and I think it is up 20% today on the market. So, very well done to Rolls-Royce. Now,
sorry to interrupt. It's had a great run, and as you pointed out, they've got a cash dividend of 6p, which I think is a reinstatement.
Yes, that's right. Yeah, absolutely.
And I think if you look at Bloomberg with the target prices, the street's a bit behind here, and the share price had a good run. But bear in mind, of course, there are a lot of people who want that dividend, so they might have to put now Rolls-Royce on the radar.
Very, very interesting. And a good point on the cash flow here, David, was that the free cash flow for the business increased from 1.3 billion to 2.4 billion. And of course, that is allowing it to reinstate its dividend. It's also brought down, it's gone from a net debt position to a net cash position. And Rolls-Royce also announced today a £1 billion share buyback. So plenty of good drivers for the share price there. Now, sticking with the subject of defence, UK defence companies, Chemring, ticker is CHG. The market cap now is £1 billion. And Chemring's main business in defence is countermeasures, so it's countering attacks. So it's very well known for its systems that protect military aircraft, things like chaff, but also in cyber security. It has a lot of sensor technologies alongside cyber. and electronic warfare. Now, Chemring announced on Wednesday this week that its full year 25 trading performance was expected to be in line with expectations, but its order books were significantly stronger. Stated that the order book was now 1.35 billion as of the end of January, and that was up from 990 million a year ago, same time. And it saw in Q1 significant order intake. So, we were always looking ahead for companies, particularly in building up orders, and very, very strong growth in the order books there. So that was announced on Wednesday for Chemring. But what we also saw, and I'm going to quote a bit from the Sky News report here, was that the company was subject to a bid from private equity, from Bain Capital, who apparently, from Sky News, has tabled a 1.1 billion proposal to buy Chemring. So the shares are up on that. According to Sky News, Bain's also prepared a second offer for Chemring, but it's unclear at the moment whether this has been submitted to the board of Chemring. In the meantime, J.O. Hambro fund managers have come out, one of their senior fund managers, and said, this is JOHCM, the fund managers, that Chemring has fundamentally transformed under the leadership of Michael Ward, the CEO. In our view, the current share price materially undervalues the long-term prospects for the group. Now, we've seen, investors will probably remember, we've seen a number of, acquisitions of big UK defence companies in the recent past, including GKN, Meggitt, Cobham. Cobham went on to acquire Ultra Electronics in the listed space, so we'll keep an eye out for further news on Chemring and that bid coming in from private equity.
Indeed, and to support Vishal's point, if you look at Bloomberg and you look at the average target prices for Chemring, you'll find it's 463. So at 390, there seems to be plenty of upside.
Yeah, absolutely. And Vishal there that Dave's referring to is Vishal Bhatia. He's the fund manager at JOHCM Fund Managers. Okay, so that's on the larger technology side. But on the smaller side, interesting enough this week, smaller one that Andrew and I commented on the past was Aurrigo International. Ticker is AURR. The market cap's about £27 million. This company is really interesting because it's exposed. This is transport technology. So it does advanced electronic and electrical systems in automotive. But what's been catching our eye for the business is in its autonomy developments, and it's developing autonomous vehicles for airports. So this is for airside, bringing the luggage containers to the aircraft and into the terminals, but fully autonomous. And they came out, Aurrigo came out with a trading update for the year ending 31st of December. Said, quote, it's made good progress in the year, expecting revenues of 8.9 million in line with expectations, and EBITDA loss of 1.9 million ahead of expectations. Remember, it's spending a lot of money and it's investing in autonomy. Its autonomous division grew strongly, delivering revenues of 2.9 million, and that's up obviously from a low base of 0.5 million in the prior year. So investing in its autonomous division and clearly seeing this drop through to revenues. The company did a fundraise earlier in this year, and it has steady cash generation. And I think, expect to report net cash 3 million at year-end close. The funding round was in January of 25, and this is year-end close in December 2024. Right, so it's reporting its results in May of 2025. So that was Aurrigo. So sticking with tech and advanced engineering, Avingtrans, David. This is one we've spoken about before in podcasts. Ticker is AVG, 120 million market cap. The shares are down by 7% in the last 6 months, but they've jumped up on interims, which it's just reported. Really interesting company, Avingtrans. So it has, in terms of engineering, it's been acquisitive. One of its main companies in the advanced engineering side is Hayward Tyler. They produce pumps, and their pumps are used in nuclear power generation, but also, very interesting enough now, in cooling systems for data centers, they have medical technology, they also have engineering technology that is used in nuclear decommissioning. So, company reported interims, revenues up by 21% to £79 million, gross margins down a bit from 31.6%. But interestingly, for me, the EBITDA profits were up by about just under 19% to £8.7 million, and the profit before tax was broadly stable. So growing sales here, holding its profitability at the moment. But this company, again, like Aurrigo, is investing in newer technologies, and it has technology in X-ray instrumentation for medical applications, but also for industrial applications in aerospace. So it's been investing in that, and that has been consuming cash in the business. What caught my eye in these results, particularly in the growth in sales and in the pumping systems, is the growth from data center investment and in cooling systems, but also its growth in nuclear. And the company has quite a presence in the US on the nuclear side. In the UK on nuclear, the Metalcraft division was progressing a second phase of a £7 million contract on the decommission of the Sellafield nuclear plant. Is providing storage boxes for materials, and the third phase of that could be worth £900 million. So some very interesting drivers for Avingtrans, longer term structural drivers in nuclear, in AI, and in data centers. Also medical, but the advanced X-ray technologies in aerospace. So that's Avingtrans, had its interims, and one to certainly keep an eye on. And to be honest, that's about it for me for this week. There weren't really, there's been a few other results about, but nothing that's really sort of, particularly eye-catching. And so with that, David, I don't think great to have you on the podcast this week. Might have you on again next week. Let's see. See when Andrew gets back. As always, if you've got any questions you'd like to ask us, any companies you think we may have missed, or more news you'd like to hear about, then do feel free to get in touch with us.
Pleasure. Thanks very much, Phil.
David, thank you again. We'll chat next week.
This podcast has been produced and edited by VSA Capital. It is intended for information purposes and not as investment advice. The information is intended for recipients who understand the risks associated with equity investments in smaller companies. Please do your own research and do not rely on a single source when making an investment decision. VSA Capital may derive fees from this content and seeks to do business with the companies mentioned.